Good evening, ladies and gentlemen. It's that time of the week again for the weekend deep dive on the market. We're going to go over the bull scenario, the bear scenario for the week ahead, and what happened in the previous week. But before we get into the video, quick legal disclaimer. This is not financial trading advice. I'm not a financial advisor or a broker. Do all your due diligence on the market. All trades you take and risk is your own. Remember, you put yourself in the trade, no one else. Let's get into the video. If you haven't noticed, the stock market was on a tear this week. It absolutely ripped every bear a new one. So we approximately on the week from last week, Thursday, ran up 5.42% on the S&P, which is an insane number. The S&P on average returns 14% year over year. If we look at from 2023, the start of January, all the way now, we're at 8%. We're about 80% to 90% of what the S&P returns on a yearly basis, less than 3 weeks. So that should be something to put in the back of our minds. Is this going to continue or is this going to fall on deaf ears? Let's start with the bull case because that's what everyone's here to really figure out. First of all, we're in an uptrend. We have not broken really this major uptrend here since the start of this push. We consolidated in this region between 385 and 375 and then continued upwards once we broke it. Pump up, flag, pump up. So what could be the next expectation? Well, we could consolidate in a downwards region heading into this week. This week is packed with a lot of data that's going to be coming out that could put the market one way or another, or we could continue higher, or in the third case, lower. You only got really three options. Where do we see the bullish notes taking here? Well, one, you're over the 50 weekly. I've been talking about this for quite some time now that you have to get over this 50 weekly with conviction, have two candle closes. Well, guys, you got one, you got two candle closes. Congratulations, we're over the 50. That doesn't mean you're out of the weeds yet. Let's look at what the candle structure is telling us for the bullish sense. I had a massive move up, so now we're expected to see consolidation here and or a retest of this 50. We get down below it, really didn't find support. We found support there. Don't necessarily want to see that on the break of the candle necessarily. You would like to see a more cleaner break rather than a gap up. If I was bullish on the market, and full disclosure, I'm still very bearish on the market, and we'll discuss that later in the video, but I'm willing to change my tune if I see these events happen. We retest the 50, and we hold the 50 without breaking through it, meaning 402.11, we do not print 402.10. I mean, you hit 402.11 on the dot, or 410, let's face it, I'll give you a cent. Go straight up from there. You need to have like if that's for the 410, you need to come down and bounce. There is no gapping like this or coming down sideways and barely closing by one. That's going to show weakness to me in the market. That's going to show a shorting opportunity. That's not going to show strength in the market. If this is the start of a new bull market, you have the potential. The potential is there. You have the cup and handle formed. Now you've broken out of it. You're going higher. So now you're above 405, which is one of the key areas that we looked at previously. Now we're heading to challenge our next contender at 410.53, which was the top of the massive CPI gap up, sell off down. You're also in probably what is a price zone right here that you're going to find sellers. We found sellers there before, so the expectation now is we find sellers. The candle on top of that is telling us we're finding sellers. However, we can continue higher because we are supported by this uptrend. We have support at the 50 weekly EMA, so there's a lot of things going for us. We're nearly going to have a golden cross, which for those that don't know what a golden cross is when the short-term moving price on the daily, the 50, which is the red line, crosses over the 200 to the upside, which is our long-term moving price. Basically, it's just an indication that short-term price is now bullish while long-term price is bearish, which is a reversal or a possible reversal. It doesn't necessarily mean we're going to pump to the moon. It just needs something that you have to keep in the back of your head. Is there anything else for the bulls that have to look out there? Pretty much, you got to not come back, break below this level, and continue higher. Break 410, next 416, the birth of a new bull market. So we're definitely going to be looking at how price action interacts from 405 to 410 to 416. You got to see support. We want to build stairs stepping up. You want to see push up, consolidate a little bit, push up, consolidate a little bit. you don't necessarily want to look back. You want to keep heading forward, going up slowly and steadily. That's how you create a new bull market. That's how you continue higher. That's how you never look back. And you have a lot of bearish sentiment that's there, that every bear that's trying to short this downtrend is either suffering pain now or got stomped out. So what do they have to do to close their shorts? They got to buy back in, which fuels the rally higher. Now, like we mentioned the bear, where is the bear scenario coming in? The bear scenario is a repeat of psychology, as I would call it. What were we hearing about when we were coming over to this area in time here? The Fed is going to pivot. The Fed is going to stop raising rates. The Fed is going to cut rates. All these things that psychologically were driving people to possibly over leverage. The market traditionally, when people over leverage in it, will result in it coming into your account and taking its donation from you and saying, thank you, come again. What am I seeing on here that has me concerned from a bearish standpoint? Well, one is you're buying every dip regardless of what it is. That's pretty ominous. And what I mean by that, one, so we have push up, gap down. You bought the dip regardless. Massive gap down, bought the dip. Gap up, sold off, bought that dip. So you're forced to buy this dip next. Gap down again, so bought the dip back up. When bulls buy, traditionally they don't sell the next day. They're long-time holders. They're creating, they're long-term investors, usually swing traders, especially with retail that's buy and hold. What they're known for. This should be a red flag for anyone that's bearish on the market, in the sense of that a reversal may be coming soon. We definitely can go higher. Let's not fool ourselves here. There is potential to go all the way to 410. I think that's when the party stops for the bulls. And we're starting to create out new breakout traders. And that's the key for the biggest hamster wheel trap of history. The volume is decreasing as well. So we have decreasing volume heading a downtrend as we're going up. That's slightly a divergence. Okay, so second thing. Or three, I should say. You have a lot of news catalysts coming out this week. And with that, let's get into the news catalyst. So Monday, there's nothing really coming out that would really move the market. Same story with Tuesday. You have consumer confidence. However, with the high amount of jobs that are in the market, I do expect consumer confidence to stay high. Nothing really has been able to push this down significantly in last months, and there's nothing really to expect that it would either. Now, Wednesday is the big daddy of news, as I call it. ADP non-farm payroll change, expected at 170. Last time it was 235. If we go into what this expectation has been versus actual, we have last month 150, 235, now 170. Probably gonna get 220. This has been the trend, that this number has been wrong so many times. It's ridiculous, guys. They were expecting huge numbers, and it's just been all over the place. So expectation for this, it's probably going to miss to the upside, and it could be bearish for the market. Remember, the Federal Reserve has put a lot of emphasis on jobs numbers. They kind of have gone away from talk of inflation. Instead, they're looking at jobs. They're saying that jobs are way too high because people having jobs creates the ability for them to then go buy stuff, which then creates the ability for prices to go up. If we kill it at the source, therefore people can't go buy stuff, therefore inflation don't go up. Logical in their brain, maybe not logical in ours, but we don't make the right decisions, they do. So we have to be receptive to that. Second, we have manufacturing PMI. That's another market mover. ISM manufacturing PMI at 10 o'clock. That's a huge market mover. I've seen that move the market 1% at least just on its own. Job jolts opening, another one that's probably bearish. This has been coming in, and they're expecting a 0.2 million decrease in jobs. I'm probably not going to get that. You're probably going to have another big upset to the upside on that, which is then possibly going to fuel the market bearish. However, I don't think that either of those two is going to move the market, because everyone is going to hyper focus on the FOMC statement and interest rate decision and press conference. This is going to be what moves the market, and I would caution anyone against moving in on a position before Jerome Powell speaks, because the market is going to rip like no tomorrow. when that 25 basis point number comes out. It's pretty much a guarantee at this point, guys. But the importance isn't of the 25 basis points, it's the importance of what Jerome Powell says afterwards. Remember, they're gonna pivot from hawkish to more hawkish. That's what I'm assuming is gonna happen in the market. I think that you're gonna see another Jackson Hole style speech, about 75% for that option. Or option two, you could actually get the physical pivot of the Fed, where they say after this rate hike, they're not going to look at rates as aggressively, or may take a pause and then hike later. However, let's look at the data and their targets to see where that's going to take them, or what they're seeing and they're targeting, and then dive back into the market to see how it all plays out. So if we look at the summary of economic projections, this is found on the Federal Reserve meeting minutes site. I'll link it down in the description below. You have the 2022 targets for real GDP. They are expecting GDP to be about 0.5, so nearly 2.4% below what it is now. So that's bearish in the sense it should be bearish for the market, because it gives the green light for the Fed to absolutely raise rates to any point they feel is necessary, because you can not raise rates, or it's very difficult to raise rates in a shrinking economy. If you raise it into a growing economy, you can slow the growth, and it's able to take that soft landing approach, as Jerome Powell would say. If we look at GDP, their 2023 targets are expecting a contraction in the economy to almost flat to no growth, around 1% to 0.4%, and the September 0.5 to 1.5. So GDP is going to probably shrink about 1 to 2% between now and September is what they're expecting. So they're expecting in September to basically be locked out of raising rates, or raising them to a very minimal amount. That's very important, because they have to weigh the consequences of all their decision in the long term. They don't just have to look at it now. Unemployment, again, we talked about this missed target back in December. It's missing target now. We're at 3.5. That's going to be a very sticking point for the FOMC members. They have said unemployment is extremely high. Jerome Powell references in his press conference all the time that employment is way too high. They're on top of expecting to see nearly, if we take the September projection, 1% higher than we are now to 0.7% higher than we are now. And then end of year target 4.4 to 4.7, which puts it about 0.2 higher. So with that, this could be the fuel to maybe, I'm saying 10% chance, see 50 basis points. If the Fed views inflation now as equal to jobs, and if they were willing to do 75% for crazy inflation, for a very loose labor market, could they shift their focus to a very aggressive tightening towards the labor market? I wouldn't say 75 basis point, but 50 basis point definitely would be an aggressive move to try to quash the labor markets, because they are terrified of inflation coming back. They're terrified that the second they let their foot off the gas, that inflation rears its ugly head, and that they have to go crazy mode then. And that you're talking 100 basis point hikes, you're talking selling off the balance sheet even further, multiple things that would catastrophically affect the economy, catastrophically affect the stock market. And they've openly said that they don't want that. Jerome Powell has studied Volcker's 1970s, 1980s inflation cycle, and has openly stated that he does not want that. He does not want a repeat of crazy Volcker moves, 20% interest rate hike in one move. He's tried to learn from history. PCE inflation. So if we look at regular PCE, they're saying 5.6 to 5.8 for the end of year of 2022 target, and 5.3 to 5.7, and we're well below that level right now. So for core, we're also below that level, sitting at 4.4 right now, or 4 from the last reading. So we're well below their target, actually on the lower end of their September projection for last year's. So we're heading in the right direction for core inflation on the Fed's target. However, they're going to still say it's still too high, just because they have a target of 3.2 to 3.7 for the year, or 3.0 to 3.4 at the end of September. And they do believe core to be a more sticky inflation metric to quench, especially if you look at PCE inflation projection for 2023, 2.9 and then 3.2. They're expecting the non-core PCE inflation to kind of fizzle out and then not to be so hyper pumped by one group of the inflation metric versus another. They're expecting the kind of core and PCE core to come back into line with one another, meaning inflation is going to be very stubborn on those core inflation pieces to stomp out. And again, the year over year number is built on a already higher percent increase from the previous year. So of course that number can come down, but is it going to be enough to where it satisfies the Federal Reserve? The federal funds rate. This is what the federal funds rate is projected to be in September of 4.4 to 4. So the possibility of going to 25 basis point hikes is very real to finish out the year, or 3 more. So it'd be February, March, and then June meeting that they would hike rates into, which would cause the remarket to have to reprice itself. They're expecting cuts in June. They're not expecting rate hikes. They're expecting no more rate hikes after March. This is basically telling you into September that that's a very real possibility that that's not happening. 5.5 to 5.4 is their end of year target, which would result in an additional 2 interest rate hikes of 25 basis points that the market doesn't have priced in to attain this target if you're going to go by the 25 basis point run. Now, March is when we get this next revision of the summary of economic projections. And if the Fed is actually done raising rates, if they are done true pivot, guys, true pivot, these numbers won't. Their federal funds rate, their unemployment expectation, PCE core has changed, revised, bearish every single time they've sent this out. The true pivot will start when these numbers stay the same, on top of, we've talked about this till we're blue in the face, 2-year and the federal funds rate cross. Right now, the 2-year is sitting at 4.2, the federal funds rate 4.1, kind of forming almost a consolidation around here, possibly right before the big rip. So if we go back to the summary of economic projections, this is something that is the blueprint for the Fed. I highly recommend everyone taking a look at it whenever they can, along with understanding what these numbers actually mean for the market when things actually get repriced in. Just because something's not repriced in now doesn't mean it can't get repriced. And this is what we consider as the immovable object. The Federal Reserve does not care what the market does. These numbers will stay the same way or get revised if they choose so. The market could go spin itself sideways for all they care. They won't revise them. So let's look at what big money is doing, and then we're going to get into what I see happening with the market. So big money, net speculative positions. From January 20th to 27th, we saw a decrease of about 10,000 position. So that's basically going to be after this big move. We saw a nice decrease in positions. However, it wasn't as shocking as the December 16th to December 23rd, where you saw the big rundown taking profits. You saw about an 80,000 position cut. Now you're only seeing about 10. So the market's ripping up, and these net kilo spec positions, which are big money, they're not letting off. So what do they know that we don't? Or what do they suspect is going to happen and we don't? If we look at the NASDAQ's another clear-cut story. January 20th to now, we have an increase, guys. We have an increase of 5,000. It's not much, but on the overall percentage basis of what these positions are we looked at, if we look into here, they were increasing into the FOMC meeting, and they're increasing here into the FOMC meeting. So what could this be telling us we need to pay attention to? This is smart money. This is not retail. This is big banks. This is people, trillions and trillions of dollars. So these are institutional traders. They're shorting the market as it's going up. So they're taking losses on their positions as it's going up and holding them, or they're jumping in and out, but the net sum of the positions is staying the same. So there's the same amount or more amount of people that are shorting the market as we were back in the previous FOMC position before Christine Lagarde of the ECB sent the market down the rabbit hole. What could we look at for that catalyst? It's pretty simple, guys. For the catalyst of this week, it's going to be Jerome Powell for the FOMC. It's as clear-cut as it can be. I think you may have some intraday movements off the news prior on Wednesday, but Wednesday is going to be the big kahuna. You on top of have on Friday average hourly earnings, which could move the market if you're in a downtrend going into Friday, I do suspect these numbers to basically send you even further. There's no hope really there for relief. ISM non-manufacturing PMI, maybe. That could, depending on where we're heading with the market, move the market up or down, continue up, continue down. It depends. Now let's take a look at the market from an overall perspective of what I see. I'll make it quick and brief. How would you set a trap for the market? I believe the bulls by Friday are going to be begging for an exit, which is pretty harsh saying that they're winning right now. But if we reflect back on history, what was added to the last FOMC statement? Loosening of monetary conditions in the markets will result in rates being held longer. That was in plain English in the FOMC statement. So why would anyone suspect financial conditions not to be loosening? If we look at financial conditions, we're almost at the level of a quantitative easing level of financial condition, meaning you have Tesla, massive rally. You have Nvidia, massive rally. You have AMD kind of going sideways. But this is an indication of when chips, like when Intel reported horrible earnings and then pumped up, people are buying these companies with no regrets whatsoever. The stock market, let's look at S&P for an example. Gap down, buy the dip. Gap down, buy the dip. Gap up, sell off, buy that dip. You're never stopping. And if we look at the 4-hour, which is a pretty good indication, we have what's known as an inverted hammer. You had buyers push the market up, sellers come slamming back down. This is pretty much an indication of possible reversal. Now, nothing's confirmed. I do suspect maybe we get a slight gap down on the market and push into Wednesday. That's what I'm seeing. I'm probably going to take out a short position going into Wednesday, depending where we are. If we hit 410, I'm definitely taking out a short position there where it's near resistance. With the NASDAQ, you're heading towards same story on the 4-hour. You have inverted hammer, bearish for the market. You could pump up to 300 on NASDAQ. That'd be a better short than we were able to hear. But you have a 75% chance that it comes up here, bumps ahead, and kind of consolidates down. I could see that happening into Wednesday, and the FOMC could be a murder event. I think this is not a bottom on the market because you have not seen volume capitulation. Tesla was a prime example of what volume capitulation was, even though I don't believe Tesla's bounce, sold off, high volume, bought back up. This is meme mania. This is people buying just to buy. You broke through 2 key resistance levels that we talked about. Things, when markets move one way or another sharply, they don't tend to necessarily hold that. They usually revert back to a consolidation area. So prime example, Tesla came down, volume capitulation, kind of consolidated actually here, and then just shot back up. So this isn't healthy. This isn't healthy for anything. And I use Tesla as a gauge for meme stocks because, let's face it, there's no fundamentals to what Tesla just did from a technical standpoint. It just has everyone that's fundamentally sound looking at this and saying this is not healthy. If you profit off this, congratulations, like full claps to you. But from a long-term investing standpoint and a technical standpoint, this doesn't make sense. It's just baffling. Like, S&P is actually constructive. The S&P is actually constructive on what it's trying to do, but maybe failing at it. So what can we see here? If this is in the bottom, which I don't believe it is, I think you could easily see a sell-off to 390, which would put you about right here. That would be from high right here, roughly a 3.63%. That's 2 days of, or 3 days of 1.5 to 1%, depending on if we sell off into FOMC or not, and where we are. It could be an interesting place to be. I would be interesting to see if we come back to retest these areas down here, which is the daily moving averages. And I think that the bulls are going to be kicking and screaming by the end of the week. How do you create the best bull trap in the century, which is take a very, very bearish rally and you break above key resistance, create new breakout traders, and thinking we're new bull market 2021 is going to come back where the market only went up, stocks only go up, and you get enough of them in this region, I would say the 402 to 410 region, and then you send it south. So we got to see what happens with it. We got to see what Jerome Powell says. We're going to be receptive to what he says, and we're going to be very key to if he's more hawkish or less hawkish. Remember that they're going to pivot from hawkish to more hawkish. So just some humor to add to your day, but be cautious, make sure you have stop losses, and take advantage of rallies, take advantage of buying opportunities. Just have a stop loss. It's easy, it's not hard, guys. Have a stop loss, get stopped out, move on to the next trade. And don't over leverage, don't over position size, and any loss you take, you can always recover from it. Even if you take a nice fat slap to the face a couple times, if you position size correctly, reassess what you're doing wrong, in the long term, you're gonna grow. So with that, guys, like, comment, subscribe down below. If you like this type of video, we do them on a weekly basis for the weekend. We'll have daily updates on the market as well. And whenever earnings comes around, like we're in season now, we do technical analysis on the stock along with fundamental analysis. So with that, hit subscribe, like, comment, tell me what you think of the video, and have a good afternoon.